So hello everyone, welcome back to my channel. And for today's video we have a very interesting financial term, or you can say a financial instrument with us, and the name of the instrument is total return swaps. So what these swaps actually do is they help investors secretly, remember the word secretly, control the assets that they don't even own, right? So try to understand this thing, that if we are using these financial instrument, you can actually control something that you don't even own, right? So let's start understanding about how this works, right? So let's go through a very strange deal for this particular financial instrument, right? So let's say I offer you a house worth, let's say, 1 crore rupees, right? So the strange part about this deal is I will remain the legal owner of that house, right? The name on the title would be mine. I will be the one who will pay the property tax, and I can sell it if I want, of course under given circumstances, right? But the best part, the deal was for you, right? For you, you will get all the upside, right? Upsides like, if the price of the asset appreciates, you will benefit. All the rental income that I will collect would go straight to you. 100% of the rental income would go straight to you. But you will also have to bear some downside. If the asset loses its value, you will have to make sure you make certain arrangements for that, right? So basically you can enjoy all the economic benefits or maybe losses regarding that particular asset, but I will be the legal owner of that house. How do you like that deal? Before you tell me the answer, do you like it or not, first tell me one question: who actually owns that house? When we are talking about in legal terms, I am the owner, right? But economically, you are owning the house, right? Because you are getting all the upside as well as the downside. So this particular scenario is basically the scenario of separating legal title from the economic exposure, is the core idea behind the total return swaps, right? So I'll follow the same pattern that I follow for all my videos. Before explaining a particular financial instrument or a term, we will first understand the problem behind it. Right? So, the best way to understand anything about finance is not going through the definition first, but understanding why that particular thing exists in the first place. What is the core problem behind it? See, the problem behind is, let's take an example of a hedge fund. Right? We're talking about a hedge fund manager. You are actually willing to invest in a particular stock. You love that stock. But the problem is, if you buy it the traditional way, let's say you want to invest 100 crores in that particular stock, the 100 crore of your capital would be stuck in that particular stock. You don't want to do that. You don't want your investment to get stuck in one particular thing, right? You are a smart hedge fund manager, and it's not just about tying your capital up. See, first of all, it is capital intensive, but you will also have to face some regulatory disclosures. You'll have to do a lot of filings, you have to submit a lot of reports, and it basically draws a lot of unwanted attention, right? And this is basically the problem with such a large position, right? You want 100 crore exposure, it's not a small number, right? Plus, above all, it will have operational constraints as well, right? You'll have to file for custody, settlement, proxy voting, corporate actions, and everything is your burden. But you're a hedge fund manager, right? You have the interest only in money, right? You want returns, right? You don't want everything associated with the assets, right? You have pure desire for the economic exposure without the friction of the legal ownership, right? So see, why do you See, why it exists in the first place is because ownership as a word is not something that exists independently. With ownership comes, first of all, dividends, then comes the price appreciation, then comes the voting right. Right? These are economic benefits. Right? Whatever the cash is distributed from the company profit, this is the pure economic return. Whatever capital gain that you will get after you sell the stock, whatever capital gains is coming from the prices of the stock rising up, that is your gain. But it also comes with voting right. See, you are a hedge fund manager. Why would you even care about voting rights of a particular company? You only care about your return. That percentage number that makes your portfolio, that makes your client very, very happy. Right? So, most investors, especially hedge fund, asset managers, speculators, they actually care about the economic returns only, which comes from dividend and price appreciation. They don't want any involvement in the voting, proxy fights, regulatory filings. They're not interested in that, and neither do they have time for that. So here begins a very start of a very brilliant idea, right? We create a total return swap, which basically separates the economic exposure from the legal ownership. You get the returns and the risk. Remember this. You get the returns and the risk, but you don't take the title to that asset. Let's understand how it actually works in real life. So there are two parties that are associated with it, the bank, and the other could be maybe the hedge fund, maybe an investor, anything, right? So what will happen? The bank would legally buy and hold the underlying or the target asset, right? Then the bank will come into contract in form of a swap contract with the hedge fund, for example, in this particular situation. What will happen? The bank would provide all the economic returns to the particular client, that is the hedge fund. They receive the total returns, which are the gains plus the dividends. Right. Now, if the bank is giving you gains and dividend, what is the role for bank? It is also there for money, right? So, what will happen? They will get financing fees plus spread. You, the hedge fund manager, would actually pay a financing cost in form of interest, right? All the assets would be recorded in the bank's balance sheet, and all the regulatory risk would be the bank's burden, right? You only get a synthetic exposure with a fraction of capital, right? With of course a set defined margin, using maintenance margin and everything, right? So the bank actually buys the assets of the target stock company in the open market. Bank is now the legal owner, right? Then the TRS contract is signed, the hedge fund and the bank enters the total return swap agreement, referencing the exact particular stock position. Then bank actually collects the total return, and 100% of it is passed in form of dividends or the capital appreciation. 100% of the dividends or the capital appreciation is transferred directly to the hedge fund, right? And then the hedge funds pays the bank a floating rate of SOFR plus 1.5 spread. SOFR is basically secured overnight financing rate, right? Plus their 1.5 spread for getting into this particular TRS situation, and it is charged on the notional amount, that is the principal, right? So what actually happens, this is basically the how it flows in the picture. So bank will own the asset would generate returns, the hedge fund would receive the economic benefits, and in return hedge fund would pay the financing fee to the bank, right? The bank would own the assets on the balance sheet, the hedge fund would own the economics of that particular stock, and ownership and exposure have now been successfully separated, right? So looking at the mathematical example to understand it more clearly, so the entire stock position was of 100 crores. If the stock rise 10%, right? The gross gain would be 10 crores. Let's say the financing cost was set as prior 5%. So 5% of 100 crore would be 5 crore. So 5 crore would go to the bank, and the net profit of 5 crore would be enjoyed by the hedge funds, right? So this is the pure maths behind it, right? The hedge fund received the full economic upside, and they actually got the benefiting of owning 100 crores of stock without putting in a 100 crores of capital. They don't have the legal title, neither did they give out their 100 crores, but they are getting exposure from it, right? Now let's talk about leverage, how it is basically, why professionals actually love TRS and how it can be dangerous. See what is happening if we are using traditional methods to purchase a stock and then getting exposure. You will actually essentially have to give out your 10 crore. Let's say you have 10 crores in your pocket, right? You will get the exposure of 10 crore only, right? So there is no leverage, right? But if you use total return swap, what you will do is basically you will give in your initial capital of 10 crore rupees, that is your equity, right? And then the rest would be funded by the bank, and you will get a exposure of 100 crores, right? So the debt or the exposure from the bank would be 90, and then the leverage would become 10x essentially. So what this 10x leverage basically tells you is, if the stock rises by 10% and the 10% gain on your 100 crore portfolio is basically 10 crore. So if you look closely, your initial equity was 10 crore, right? So you can essentially enjoy a 100% return rate. But of course, before that 100% return rate, you have to make sure you minus the financing cost, right? After financing cost, you are experiencing nearly 50%. Let's say the financing cost is 5%, you are literally experiencing 50% return on your capital, right? Now the same 10% more move delivers 10x return on equity because of the embedded leverage, right? But swap itself is not just a tool, right? It's just like a tool. How you use it actually makes a difference. It can actually help you build a house, or it could actually break a window in a cold morning, right? But the real question is, how much leverage sits on top of these swaps? Is it 5x, is it 10x, or is it 20x? And see, it totally depends on the investor at this particular point of time, right? So TRS as its own, it's not creating risk by itself, but what and where the risk is actually coming from, it is coming from excessive leverage, right? See, it is coming from concentrated position. See what is happening, you are actually interested in a particular stock, you are getting an exposure of 100 crore on maybe some of the similar stocks of that matter, and that is actually creating a very major concentration position. Any little bit of negative noise in that particular environment could actually bring down your entire portfolio, right? Which might be caused by market stress, right? And this welcomes a potential disaster, right? Now again, let's come back to the question that we earlier asked. So legally, the bank is owning it, right? It appears on the bank's balance sheet, and basically the bank files the regulatory disclosures. The hedge fund is actually controlling the economics. They are getting the gains, they are suffering the losses, and they are the one who are making the bet. So hedge funds are, through this, are controlling billions in exposure. But the problem is, they are not appearing in public ownership filings. Who is coming in public ownership filings? The bank are, right? And this is why this is creating a transparency problem. Who is, see, okay, we understand legally the banks own it, but hedge fund is benefiting from it, right? How would investors actually, or the normal public would actually be identifying that the economic, who is the economic benefiter from this particular thing, right? And this is why TRS is so controversial. And now, for now regulators want you to make sure you do more swap reporting under the Dodd-Frank and EMIR regulations, right? So now let's talk about Archegos, and this is one of the biggest examples of the total return swaps. So basically what happened, Bill Hong's family used TRS across multiple prime brokers, right? And they basically created a very big, a massive, concentrated, we have talked about it, concentrated long position, not short position but a long position. So we're aiming for value addition or the stock prices going down, right? But this concentration problem came from a handful of stocks, which was Viacom, CBS, Discovery, and some of the other stocks like this, and it was brutally massive, right? And again, they triggered no disclosure rules because of TRS. Banks were the one who were actually holding it. So as the stock prices initially rose because they had a long position, the gains increased, and basically they increased the exposures as well. So leverage actually compounded. But when concentration became extreme, no single broker was able to see the full picture because it was across multiple prime brokers. So no single broker had the entire picture of what is happening in that particular scenario. And when in March 2021 prices actually fell, and that too sharply, margin calls, we have talked about it in a particular video, and we know how painful margin calls can be. Margin calls starting hitting from every direction, which basically led to forced selling caused by the liquidity spiral. Because when margin call is coming from all directions, you don't have unlimited cash in your pocket, right? You can't fulfill all the calls, right? So bank basically suffered billions in losses. Credit Suisse, one of the biggest one to take the hit, actually lost approximately $5.5 billion. And the real lesson here, see, TRS was involved in this problem, but TRS alone was not responsible for this problem, right? It was not the core area to be problematic. Leverage amplified it, concentration magnified it, right? Plus the opaque multi-prime broker synthetic position hid it until it was very late. The instrument definitely enabled the strategy. The incentives and the risk management failure turned it into a crisis. So this is the lesson to learn here, right? Now let's learn and talk about the risk involved with the TRS structure. First of all, we have the leverage and the margin call risk. This I hope you understand very clearly if you have seen all my previous videos. I am definitely 100% sure if you have seen all my videos, these 2 points would never be an issue for you, right? Then comes the counterparty risk as well. If the bank is only one who is defaulting, who is actually the legal owner of that particular asset, right? So the other side is definitely exposed. And with leverage risk and margin call, liquidity risk in crisis is always accompanying you, right? We have the concentration risk for this particular scenario as well, right? You're not diversifying your asset or your portfolio at that particular time, right? You're concentrating on a particular set of stocks. It could be one stock as well, right? If you want direct exposure on something, it could be one stock as well, and that is creating a concentration problem. Then we have the hidden exposure in forms of regulators and the investors, which can't actually see the entire economic positions very clearly, because legal ownership is actually with something that is shown to the public, not the economic benefit, right? So what is happening? It all starts with the investors who want an exposure to an asset without the operational or the disclosure burden of the ownership. He don't want all the voting rights. He don't want to get mixed up in all the filings. What he does, he approaches a bank, right? Or maybe a prime broker. They provide him with the synthetic ownership. They end up earning fees, right? And they actually manage the collateral and margin on the position. As simple as that. But talking about the macro situation, leverage builds up invisibly. Their interconnected exposure can amplify the shock across the financial system, and this is what creates a problem. Not TRS alone, but all the economic uncertainty in the time of crisis where everything fails, it fails as well, right? So a TRS is not really a bet on that particular asset, it's just a contract that helps transfer the economics of ownership without transferring the ownership itself, right? So it basically is doing something like, you don't need to own the storm to bet on the rain, you just need someone to hold the umbrella for a fee, right? So now I'm sure you understand one of the most powerful and misunderstood instruments in finance, the TRS, total return swaps. And if this made you see ownership differently, then that was the point all along. Subscribe if you want more such deep dives into this hidden plumbing of the global markets. Like, share, and comment, and I'll see you in the next.